In 2025, Denmark is emerging as one of the most stable yet strategically evolving economies in Europe, and investors are taking notice. GDP growth is projected at 3.6% by the European Commission and 2.9% by the IMF. While this is a slight moderation from 2024, it still places Denmark ahead of several other advanced economies. Inflation is well contained at 1.6%, unemployment remains modest at 6.2%, and public finances are solid with a projected government surplus of 1.5% of GDP. For hedge funds and global investors, this balance between growth, stability, and fiscal prudence signals an attractive investment climate. The key drivers of Denmark's 2025 expansion are its pharmaceutical sector and renewed North Sea energy extraction. Pharmaceuticals continue to anchor industrial production, fueled by global demand for biotech innovation, while energy extraction supports exports and strategic energy independence in Europe. These sectors present long-term opportunities for funds looking to balance defensive plays with cyclical growth assets. On the policy front, Denmark maintains a fixed exchange rate regime aligned with the European Central Bank, meaning its monetary policy is effectively neutral. This predictability is vital for hedge funds and asset managers seeking to hedge currency risk while positioning in Danish equities or fixed income. Fiscal policy, meanwhile, is tightening slightly, with defense spending rising from 2.25% to 3.25% of GDP in response to NATO commitments. While this reduces the budget surplus, it reflects fiscal resilience rather than strain, given Denmark's overall prudence. The financial sector remains one of Denmark's strongest assets. Banks are well capitalized, with robust profitability and liquidity, and the Danish Financial Supervisory Authority, DFSA, has unveiled its 2025 strategy focused on four pillars: risk resilience, fair customer treatment, sustainability and climate considerations, and advanced digital supervision. This framework reassures investors of both security and transparency in Denmark's financial system. However, the IMF has flagged vulnerabilities in the commercial real estate sector, suggesting tighter borrower-based measures could soon come into play. For real estate-focused investors, this is a double-edged sword. While risks are contained, future restrictions on leverage could dampen high-yield property plays. From an offshore banking perspective, Denmark represents both opportunity and constraint. The DFSA's strict stance on anti-money laundering, terrorist financing, and IT security means offshore structures face significant compliance hurdles. Yet the upside is reputational. Alignment with international regulatory standards positions Denmark as a secure financial hub for legitimate cross-border flows, particularly for institutional investors seeking ESG-compliant jurisdictions. For hedge funds, the key investment takeaways are clear. First, Denmark offers a stable macroeconomic backdrop, ideal for long-term allocations. Second, pharmaceuticals and energy are strong sectoral plays with global relevance. Third, while fiscal prudence underpins stability, rising defense spending and geopolitical uncertainties could reshape budget dynamics in the medium term. Finally, investors must watch the commercial real estate sector closely, as regulatory tightening could impact leverage-driven strategies. In conclusion, Denmark in 2025 represents a paradox of opportunity and discipline. It's a country where growth is strong but tempered, where regulation is strict but confidence-building, and where sectoral plays, from biotech to energy, are poised to deliver returns for investors who can navigate the rules. For hedge funds and global investors, the message is simple. Denmark isn't the most high-risk, high-reward bet in Europe, but it may just be one of the most secure anchors in an otherwise turbulent global financial landscape.